In India, we have a system of income tax. People who earn income need to pay a part of it to the government. This money is used for the development of the country. The Income Tax Act of 1961 governs how income tax works in India. It's a very important law that defines who needs to pay tax and how much. Understanding the basics of income tax is crucial for every citizen. It helps us understand our rights and responsibilities. One of the fundamental concepts in income tax is the term person. The Income Tax Act doesn't just apply to individuals. It uses the term person to define who needs to pay tax. This is a broader term than you might think. It's not just about human beings. According to the Act, a person includes individuals, but it also covers other entities. This means groups, organizations, and even legal fictions can be considered persons for tax purposes. The Income Tax Act recognizes several categories that fall under the definition of person. Let's break down these categories. Individual. This is the most straightforward category. Every individual who earns income in India is considered a person for income tax purposes. For example, a salaried employee, a self-employed professional, or a retired pensioner are all individuals. Hindu undivided family, HUF. This is a unique concept in India. An HUF consists of all the family members descended from a common ancestor. It's treated as a separate entity for tax purposes and files its own tax returns. For example, a family running a business together can be considered an HUF company. A company, whether private or public, is considered a separate legal entity and is treated as a person. They have to file their own tax returns and pay taxes on their profits. Reliance Industries or Tata Motors are examples of companies. Firm. A partnership firm which involves two or more individuals carrying on a business together is considered a person. The income of the firm is taxed, and the partners are also taxed on their share of the profits. A law firm run by multiple partners is an example of this. Association of Persons, AOP. This is a group of people who come together for a common purpose. Unlike a company or a firm, an AOP doesn't necessarily engage in business. A society formed for promoting art and culture can be considered an AOP. These are just some examples. The Income Tax Act provides a comprehensive list of entities that are considered persons. It's crucial to understand the concept of person in income tax because it determines who is liable to pay tax and how their income will be assessed. Different rules and tax rates may apply to different categories of persons. For example, the tax slabs for individuals might be different from the tax rates applicable to companies. Similarly, certain deductions and exemptions might be available to specific categories of persons only. Therefore, understanding who qualifies as a person helps taxpayers determine their tax liabilities accurately. It also helps them plan their finances effectively and comply with the provisions of the Income Tax Act.